Hey, everybody. So this is the first episode of the Bootstrap interview series where we're going to talk with investors and lenders who offer non-dilutive financing. We believe that's where the world is going. There's so much content and information out there about venture capital, and not nearly enough attention is paid to the other 99% of companies who are raising financing in numerous other ways. So particularly those that are looking to build something from the ground up and bootstrap their company, there's a kind of a dearth of information out there. So in my point of view, bootstrapping a company doesn't mean you can't use other people's money to get started or to help your company grow along the way. And that's part of the reason I'm really excited to be speaking today with Derek Manuge. So for a little background, Derek has a really deep background in financial and technology space. He's worked at BlackBerry, Scotiabank, KPMG. He's an economist with Key Living. And most recently, he serves as the co-founder and CEO of Corl Financial Technologies. So I'll let him talk a little bit more about that in detail. But with that, I'm really excited to welcome Derek to the program. So Derek, hello.
Okay, thanks,
Hey,
Thomas.
of course.
Happy to be here.
Great. So let's dive right in. Just if you could tell us a little bit about, Corl, why you originally founded the company, some of that original insight would be really great.
Yeah, Corl's a financial technology company, as we broadly define it. And our focus is offering revenue sharing financing to startups. The way we do that is a little bit different than most people in the industry, because we like to focus on data and automation as the means of facilitating the investment. For us, the reason we started the company back in 2016 was primarily because I used to be a consultant in the space, focusing on analyzing the portfolios of a lot of banking institutions, venture portfolios, small business financiers, and quickly realized that not many of them offered financing products for startups that didn't have assets, or if they did, it was more equity-like instruments that was a very high cost of capital and was limited to a small subset of the startups that existed. And when you look at the numbers, about 1% to 2%, less than 2% of all startups or small businesses get access to venture capital financing. And so what is out there for this 99%? Well, there is friends and family. There is bootstrapping with your own capital. There is debt-like instruments if you're willing to put up a personal guarantee. But for a business that doesn't have real assets or many liquid assets on their balance sheet, they can't really access more traditional bank-like financing. So for us, this was an opportunity to provide a financing product to grow quickly and get access to capital in a fashion that would be quicker than traditional venture capital. Also cheaper than venture capital, and serve the 99% of businesses that venture capital currently does not.
Awesome. Faster and cheaper is a good combination. And then kind of looking forward, what are you most excited about for the coming year? I know you guys are building a lot, working on a lot, have a lot going on. Is there anything in particular you're psyched about?
I'm excited for more awareness on the space in particular. For about 80 years, I guess, since the beginning of quote unquote venture capital as we know it today, there hasn't really been a lot of innovation in the funding or financing space. It's been, raise a bunch of money as part of a venture fund, getting together a bunch of your LPs, and the GPs or the fund partners will make decisions on where to allocate that capital. And then in, a 8+ year time horizon, expect some exits in your company and your portfolio such that you can return capital to those investors. That's traditionally been the venture capital fund model. We're now starting to see an evolution towards more automated based financing solutions like ours, or what I would broadly define as capital as a service. And I'm excited about now that these types of solutions are starting to become more ubiquitous in the market. Founders and entrepreneurs are becoming aware of them and are realizing that there is now an alternative to venture capital. And it comes with a lot of benefits that you would not traditionally realize. And so I'm excited about the awareness that we're going to have in 2020. I think revenue sharing financing, revenue-based financing in general, won't be, a term that's only known by financial engineers or really savvy financiers in the space. But it'll become more of a dominant force in terms of how companies are viewing their capital stack and how they're optimally designing their capital stacks to be able to grow over time.
Right on. So for folks that are looking for revenue-based financing or maybe applied it through your company, what are some of the mistakes that you've seen, founders or executives make when they're either seeking it or in terms of how they're thinking about it? Is there anything out there that in terms of advice you'd essentially be giving those to those folks considering it?
Yeah, so it's kind of similar to equity. So when you go to a venture capital firm and they write a term sheet, the terms on the sheet can be very different from someone else that's an equity investor. And so one, I guess, mistake I would say is that a lot of founders would come to us and think we're the same as all of these other revenue-based financiers, when in fact, there's very few that have overlapping terms. If you break it down in terms of its financial instrument, we are a perpetual royalty financing instrument. Whereas, for example, Lighter Capital, who essentially dominates the space right now, they own well over 70% of the market share, depending on what statistics you look at. They have a non-perpetual royalty, similar to SaaS Capital. And there's a combination of these smaller venture funds that are starting to play around with hybrid instruments that either convert into equity or pay down equity over time. And they're very interesting models. They get increasingly more complicated, but it just goes to show you that, I guess, the one mistake that an entrepreneur would make is that they're all the same when they're really not. You have to really read the terms in some of these sheets. Yeah,
interesting. And then, just following on that one step further, is it relatively straightforward, or do you find that people need attorneys to do that, to dig into the weeds on the term sheets?
On some of the term sheets, you definitely want your lawyers to read them. However, the reason that we designed ours, and we did a lot of work back in the early days around this, is we wanted to make it as simple as possible so that people could understand what it actually is. So, and just to maybe explain our model, a perpetual royalty is essentially a percentage of monthly revenue over time, and then the business has the option to buy out the contract at some predetermined amount. So very simple instrument. I mean, there's obviously terms in there, but there's no real financial surprises that you wouldn't normally know of just by me explaining the instrument. So it's a pretty simple model. I would definitely recommend legal counsel for any types of contracts that you sign, but be careful in mind that you can easily burn through all of your financing by hiring lawyers.
Yeah. And of course, this isn't legal advice and all those other typical warnings.
Yeah, that's right. Add the flow of disclaimers to this one.
Yeah. Awesome. And do you think, especially since you guys are technology enabled, that kind of the transaction cost associated with getting RBF, do you think it'll ultimately ever get low enough to where actually the amount of loans you're able to get is really small and I'm able to borrow, $500 when I'm just starting out, things like that?
Yeah, well, what's great is that royalties have been around for a really long time. And in the oil and gas industry, for example, it's been popular, like mining, extraction, pharmaceuticals, software, music. So it's not a new concept. It's just a new concept that it's being applied to startups. And so the reason that in the past it was kind of overlooked for high growth companies is because there's an operational challenge and almost a financial challenge to be able to manage many of these contracts, because there's a lot of overhead. It's like you're doing the initial analysis, due diligence that would be required, similar to an equity deal, but then on a monthly basis you have to continually calculate accurate financial statements, do your credit reviews, ensure that the payments are getting made on time, collect the payments. So in the past, I can understand why people would not have generally wanted to create a royalty fund, for example, in the venture capital space. However, nowadays, the remittance of payments are very cheap, very quick. You can automate it all. And so for us, that was largely our focus. It's, how can we keep the cost down, and how can we automate as much as possible so that the experience for the consumer is great, and we don't have to worry about manually calculating these royalty payments on a monthly basis. And so right now, I would say that we're at the point where micro revenue-based financing, although does not exist today, it is theoretically possible given the technology stack out there. And so for us, while we will do a minimum of about 25,000, there's nothing precluding us from going downstream. It's just a matter of how we view our risk management and whether or not we feel that $500, would be adequate financing for a company to do anything.
Yeah.
And so I could see it being more popular in the consumer space, specifically as a replacement to certain payday loans or payday options, and could also be quite popular in other geographic regions where there's less of a banking or financial system in place. Certain regions in Africa, for example, or Asia. So I see an evolution there from an income sharing agreement standpoint. However, venture capital, as you know, is a pretty financially intensive industry. And so if you're planning to grow your company from 1 million in AR to 10 million in AR, $500 isn't really going to get you more than a couple Uber rides.
Yeah.